July 2024. So, for regular listeners and those who've tuned in many times, you'll know I like to start with a quote, and I thought an appropriate one for this week was, I hope you realise that every day is a fresh start for you, that every sunrise is a new chapter in your life waiting to be written. And that's from Juanson Dizon, who's an author, who also happens to have clinical depression, and that bit was a bit of a fluke. But before we get started, I want to say a big thank you to all of those who attended the Property Business Workshop on Thursday, July the 4th in London. It was definitely the best thing that happened on Thursday this week. Only kidding. As you know, I largely attempt to stay apolitical. I like to subscribe to the old worry about what you can control, not what you can't control. And I prefer to try and call it like it is. Look, this week there's got to be a post-mortem, relatively quick, in which I stick to what is weird about the election result. And then, ultimately, we'll get on with the usual, which is the macro, the real-time property market, and then the deep dive. So, it's a new beginning, ultimately, the start of the second half of 2024 and beyond. What's it got in store for us? The excuses for the new government have already started thick and fast. So, thanks for joining me today, and thanks for sticking with it after that election campaign, which took its toll on all of us, I'm sure. So, onto these strange features of said election. Starmer comes in as one of the least popular new leaders of all time, and amazingly, only the fourth Labour Prime Minister to win a general election since 1906, since the foundation of the Labour Party. So, pretty incredible, really, when you look at it like that. Only the seventh Labour Prime Minister at any time. So, they've had three effectively unelected and now four elected, interestingly enough. Far more popular than Sunak was when he went out the door, of course, but there we go. 33.7% of the less than 60% of registered voters that turned out to vote voted for Labour. That compares to 40% of the 67.3% that turned out in 2019 who voted Corbyn. So 571,000 fewer people have voted for Starmer rather than for Corbyn in the end. The smallest percentage of any majority government in British electoral history. And the third most popular party by percentage of votes, Reform, got 14.3% of the vote and 5 MPs. The fourth most popular, the Liberal Democrats, got 72 and they got 12.2% of the vote, not a typo. So, other than the obvious relief, it's just an incredible display of what first past the post truly means. Time will tell as to whether the system where 2/3 of those who voted have voted for something else and 1/7 have fewer than 1% of the MPs is a triumph for democracy or not. It's clear in today's world, though, looking at the events in France where the parties are busy collaborating to shut out what is seen as the extreme, even if some of those collaborating are themselves somewhat extreme at the other end of the political spectrum, that the system will do whatever it can to try and stop the middle being hollowed out. But time will tell whether that works or not. We, sadly, are the guinea pigs. But you'd have to rather be in the middle rather than the outskirts, you'd think. The biggest fear is we'll have not a Starmergeddon, but a sludge fest for the next 5 years, leading to a change looking like a great idea in 2029. But what will that change be? That's nearly enough for the moment. Starmer has promised to be boring, and in the absence of spitting image to portray him as such, he does seem to be doing what he says he's going to do. There were whispers of John McDonnell being appointed to the cabinet, which were enough to have me reaching for the Valium after fearing the appointment of a Marxist chancellor back in 2017 and 2019. But the surprises were limited to Patrick Vallance, who you will remember from such classics as Lockdown 1, Lockdown 2, Judgment Day, and Lockdown 3, This Time It's Pointless, and James Timpson, which honestly looks like a brilliant shout. For those who do not know, this is indeed the boss of Timpson's The Key Cutters, and best known hirers of ex-cons there are out there. Straight to the Lords for Timpson to allow this to work. It looks like a superb precedent, but will no doubt one day be abused, unfortunately. This one looks like a good one, though. Okay, before we do move on, we just need to spend a moment just lamenting those who lost their seats. You didn't think I wasn't going to mention the end of the lettuce, did you? Outgunned in her safe seat, Truss was the Portillo moment, which refers to the surprise defeat of Michael Portillo in 1997, the last time there was a massive swing leading to a landslide. This time, though, the swing was basically all negative against the Tories, which led to all those election anomalies, a giant 20-point swing against them. Others to lose their jobs were Rees-Mogg and Penny Mordaunt, who definitely would have been in the leadership race for the new leader of the Conservatives, which is probably a far less poisoned chalice, but not yet free of problems. Jeremy Hunt just held on, which was probably fair after a solid run as Chancellor. Ultimately, as you'd expect, I had my eye most on number 11 Downing Street and who would be incumbent. It would have been an incredible and unwanted surprise to not see Rachel Reeves take up the mantle, and indeed she has. The bond markets, the ultimate bellwether, didn't move a single tick as the results rolled in. This was all already priced in. Compare this to the movement in the rates in France over the past few weeks, and I know where I'm glad to be, although the rates in France for debt are still far lower than they are in the UK or the USA. And then the excuses started straight away. No Chancellor has ever taken over the economy in such a bad position, apparently. I'd say that's a touch subjective, but this isn't going to be easy. Labour have ultimately created their own problems because there's a whole number of surveys which are long running, decades long, showing that at this point in time, people as a whole would pay more tax for better public services. Part of the Conservative downfall, no doubt, pushing lower taxation policies when only a minority of the electorate thought that this was the time, or it was more realistic to do so. Also, it should be noted, whilst the tax burden is the highest for 70 years, the tax on the working person, as measured by income tax and national insurance, is lower in percentage terms than it has been for 15 plus years. The very strongest support for tax rises is for funds directly for the NHS, which is why the reversal of the national insurance position was a strange decision, probably Sunak's biggest U-turn other than Rwanda, which has now already been scrapped, of course. Really enough politics now, though. Let's pretend I wasn't getting messages from people on Friday morning saying, see you at the airport. They did tend to have smiley face emojis after them. The show goes on and we go real-time market, macro, and then a dive into the monthly reports. So the weekly shout out now to Chris Watkin and his real-time market data analysis. June's sold subject to contract figure ended at £348 a foot after holding at £350 for the whole month. So it ends up looking like a flat month because that's the same figure as May, which would be fair to expect with rates moving up and down and also with the election in play. That number, though, is still 5.1% ahead of December 2023, and so the 5% shout for 2024's property market growth still feels pretty accurate to me. Listings are still way above average, 7.5% above, compared to the pre-pandemic market. Net sales in the week that ended 30th of June were 20.8% higher than the same week in 2023, which speaks volumes. They're still 4.7% above the pre-pandemic average. So very little changed in the month, and the election seems to have passed through the property market without much incident. In this coming month, I would expect activity to pick up for the first few weeks, but the summer lull is still likely to occur. There's not much in terms of reasons why not. It would have been easy this week to have the eye completely off the macro ball, but there's no excuse for that in the first week of a month. We always get the Bank of England money and credit report, which I will cover in the deep dive. But also, Nationwide and Halifax prices for June fell in the same week this month. The final PMIs, which are very important, and the money supply, which I just want to revisit briefly. I'll round up the macro, as always, with the gilt and swap yields, of course. So Nationwide and Halifax. Nationwide were plus 0.2 for the month of June, Halifax minus 0.2. In an amusing turn of fate, the consensus was that Nationwide would be down and Halifax would be up. So you could do better tossing a coin than some of these forecasters, but there we go. You do get the feeling that sometimes it's a little more than that coin toss. If we went from Watkins data above, then June itself would be flat. So all of those three ducks do look in a row for June. You could consider that a win for the market, though, with the uncertainty of an election, although you could easily counter that by saying there wasn't any uncertainty and it turned out exactly as expected, which broadly it did. Nationwide went with a broadly stable headline, 1.5% up on 12 months ago. Okay. They note there are 15% fewer transactions than in 2019 thus far at this point in the year, although there are more sales agreed, and that lag is likely due to the performance in the second half of 2023, all of which is deals completed in Q1 of 2024, of course. But I want to make a more technical point about a mistake I see compounded again and again in these reports. Here's what Nationwide say. Today, a borrower earning the average UK income, buying a typical first-time buyer property with a 20% deposit, would have a monthly mortgage payment equivalent to 37% of take-home pay, well above the long-run average of 30%. The broader point, which is rates are much higher and so monthly payments are much higher, is of course correct. However, comparing the average UK income to someone buying the typical first-time buyer property is silly. Owner-occupiers with mortgages in the last English Housing Survey were identified as having average household incomes of 59k compared to average household incomes for renters of 31k. That's the scale of the disparity. Forget the average income, forget it as one person as well. It should be the average household of the particular age of a first-time buyer income, which has stabilised between 31 and 34 for many years now, in spite of what the press say about this. I almost didn't use the image that I did use as this week's image because the grading that they used annoyed me so much, because what the image is it's an image of moves regionally in the property market, but it bands them between 0 and 5% upwards, 5 and 10% upwards, 0 to -5, and -5 to -10, which is pointless in a market that's as flat as this. We could have done those with 1% bandings, but because the picture still tells 1,000 words, I used it. The economic south is lagging behind the north in terms of house price movements, as the higher payments bite harder in the south, and also as the investment possibilities in the south are constricted simply by the price of the debt. Nationwide didn't try to do much more this month. Halifax went with stable and is at 1.6% up over the past 12 months, in spite of their -4% prediction for the year of 2024, which we now know is very wrong. They now expect modest price rises for 2024 and throughout 2025. So finally, they've woken up and smelled the coffee. Well done, Halifax. They also did very little more than that this month in their reports. The PMIs, well, we had the flash PMIs a couple of weeks back, and the suggestion was that the election had slowed things down. There wasn't a huge change on those numbers, although they did improve a little bit from the flash numbers. Manufacturing at 50.9, which is just moving forward ever so slowly, noted a 17-month high in input cost inflation. That's not helpful for rates overall, of course. However, they do note recovery in output and new orders and business optimism close to May's high. It's also worth saying that ultimately, in manufacturing, there's been actually a quite significant drop in input costs over the past couple of years, as demand, apart from anything else, has really calmed down. They also talk of job losses as a result of the renewed inflationary pressures in the sector. But we know that services are much more important as far as the share of the pie goes, and the number, which was 52.1, was the 8th month in a row above 50. The second quarter average was not far off the first quarter average. The report still cites election uncertainty, although notes it is over now. Note this, which differed from the manufacturing report though, and more importantly, differed from some of the mainstream narrative on inflation. Prices still continue to show a high degree of stickiness in the UK service sector, although input cost inflation once again trended lower in June. The direction of travel here is encouraging for the Bank of England, but our survey's gauge of prices charged actually rose on the month, as some companies noted their pricing power was strong enough to raise their fees. So, input cost trending down is good, of course. However, there's still room for even higher prices, and companies are, of course, right now very expert in using that power, as they've got right back behind inflation, as long as that inflation is of their bottom lines, of course. Confidence in the future slipped, and services had a lower percentage of firms being bullish over the next 12 months compared to manufacturing, mostly citing potential uncertainty in government policy. You could perhaps reframe that as, we don't mind what we've heard so far from Labour, but we'll believe it when we see it, which I think would probably be a fair shout. The composite PMI, which combines everything, noted slightly increased employment, although very marginal, and the lowest print of 2024 so far at 52.3, which is still a solid number, but the jury will be out until we see next month's figures and see how the election has fallen out of any stickiness in orders and decision making. Construction PMI was also released, and the headline once again is a continuation of the current trend. Total construction output continues to rise despite renewed drop in housing activity. Commercial is leading growth. Employment has increased in construction more than it has for 10 months, and inflation remains muted. Overall, good news. Overall, just remember that if you hear construction is doing okay, it is not doing okay in residential work as yet. Residential output fell solidly. Commercial PMIs remains around the mid-50s, civils activity around the low 50s, and housing activity below 50, as it has been for around 2 years now. The industry overall is optimistic, more so than the services sector, more in line with the manufacturing sector. So, in summary, the future looks okay. A poor second half of 2024 looks unlikely at this stage. Now, I said this week I wanted to talk a bit more about the money supply as a separate point. This has moved fairly favourably for the past 12 months in the UK now, which is basically sideways and a little bit downwards. The money supply for some economists is a much better predictor of inflation than other measures are. The past 12 months really do look under control, which makes me feel a lot calmer about the current rate of inflation and the future numbers. I'm now stuck predicting in a range of between sort of 0.5% and 1%, which is much more typical of normal times than in early 2022, for example, when I first said, right, inflation will be over 10% now, and many thought that was laughable. Remember, 11.1% was our top in October 2022, and it was only held down there by the energy price cap. And indeed, we had 6 months in a row with inflation above 10%. The other point I wanted to make here is that it looks under control enough to not continue selling bonds that the Bank of England bought when rates were incredibly low. Don't sell them into the market right now and crystallise those losses. This is still slated currently to cost us tens of billions, as I've written about over recent months, and it can be avoided at this point. We get to see whether the bank agrees with me in September's meeting, and if I was Rachel Reeves, I would be putting incredible pressure on them to agree with me, because apart from anything else, that 30 odd billion spend of losses that we've still got would then fall out of the figures, and that 30 billion would become available for government spending. Let's see. I always round up the macro on the gilts and swaps, as you'll know, and as I said already, markets didn't miss a beat with the election result, which was as expected. On the 5-year, we opened the week at 4.063 and closed at 3.984, and you know by now that down weeks always make me happy. The psychology of being under 4% is good too. There were no big changes, just a small drop when the election uncertainty dropped out, and another small drop when US unemployment ticked up a bit more than expected, which makes US rate cuts more likely. There was a massive disparity between two reports on the US economy this week around their services sector. One was very negative for everything other than prices. The other, the more widely respected one, still shows an economy that did very well in June. Time will tell. So Thursday's gilt yield closed at 4.056%, and the 5-year SONIA swap was 3.952, which preserves that 10 basis point discount that's now appeared. Expect that down a few more points as we go into a new week, and there is no reason currently for rates to go upwards, although the cuts we would have expected to have happened in lenders' mortgage rates have already happened, largely. They haven't waited until after the election. All looks calm enough on the macro seas, and it would. The debt squeeze is a slow and painful process that has not yet fully played out. And what am I talking about when I say the debt squeeze? I'm talking about people dropping off lower rates of debt and falling off onto higher rates, and that's squeezing people's margins and available income. That's happening for investors, and it's happening for households, and it has been happening, of course, now for the best part of a couple of years. That fiscal drag will continue to affect the housing market and the wider economy as a whole. I want to make a couple of points before I get into the Bank of England Money and Credit Report deep dive. Firstly, GDP over the past few years has, frankly, been a dodgier measure than ever before. One reason is the large population increase. So we've had GDP up, but GDP per capita or per head down. The result, people don't feel better off because per person they are not better off. The bigger reason, though, in many ways, is a reminder of what GDP is the sum of. And it is the sum of consumption, government spending, investments from a business perspective, and net exports. So exports minus imports, which is usually negative in the UK. Consumption, even before inflation, is down or very flat. There aren't any real-time figures, but Q1 2024 was still 1.9% lower than Q4 2019, according to the ONS. This is making the now traditional comparison to before the pandemic. Now, bear in mind, that's not adjusted for inflation, right? Not adjusted for inflation. It's still gone down. So that's a serious haircut in consumption. The frugality that the pandemic forced and encouraged upon us is not gone. Or the much higher cost of living, even just targeting shelter, whether you rent or whether you own with mortgage, has sucked out funds that would otherwise be consumed. And as noted in previous weeks, a meaningful savings rate and interest rate is clearly encouraging some to save rather than to spend. So then you apply inflation, and GDP is down hugely on its largest component, which is normally about 2/3 of GDP. So how then have we avoided a massive recession? Simples. The answer is already obvious to you, I'm sure. Government spending. That is up 36.9% since before the pandemic. Even applying a generous rate of inflation since then, of around 23%, you can see that's made up for it. Now that's of course unsustainable, But what do we take away from that situation? Firstly, as discussed, people would pay more tax as a whole for better public services. The argument will always be, would that more tax lead to better public services? Secondly, there's plenty of room for consumption to bounce back in the UK. We should be really bullish about the future of UK consumption on the back of this. The population is more than 2 million higher than before the pandemic, and there's a huge amount of room for consumption growth. But we will need the change in interest rates to continue to filter through without incident, and a return to growth in GDP per capita incomes that is sustainable, which is at least a year away. We probably also need a lower incentive to save, so geopolitical stability plus a haircut in interest rates of 1 to 1.5%. And then thirdly, government spending needs to be controlled in the absence of raising quite a lot more tax. There should rightly be a huge amount of inefficiency to cut out, just because that's grown that 37% in just a 5-year time span. Meteoric growth of something already massive always leads to inefficiencies. All the figures point these out. They will and can be ironed out over the next 5 years. We're still 1.2% worse off than pre-pandemic, using Q1 2024's figures when it comes to GDP per capita. The usual caveats around averages apply. I'm just going to pause for a second there because I've had a question from SS Rentals. Am I still assuming a 25% increase in prices over the next 5 years, or do you think it will be 30% plus? So KCCO, which must mean keep calm, carry on, which I love. I think the 25% is, I wouldn't want to say I was hopeful for 30% plus at this stage. We've got to see what's going to filter through, and we have got this debt drag to get through. So a fair bit's going to be predicated on the interest rate, but I think ultimately we're going to see a 5% increase this year when everybody thought we were going to see nothing. Now, how much of that do you ascribe to rebalancing what happened in 2023 and late 2022? Maybe a reasonable amount of it, but we're still going to have, in my view, fairly significant inflation to deal with. Inflation over the next year will be 3.2. Expect wage inflation to be closer to the 4% mark or whatever, which is all going to filter into affordability. And I would expect those interest rates to decay a little bit, perhaps by 0.5% on the gilt yields over the next 12 months. That would be my best guess, something like that. And if we get there, then ultimately that's perfect storm directions. Higher wages, probably more help. Let's see what the freedom to buy government guarantee mortgage scheme looks like and all the rest of it for first-time buyers. If all these affordable homes come in, of course, there won't be as many reasons to buy a property apart from anything else. But I think we all know that Labour have got at least 12 to 18 months of significant challenge to even lay the groundworks for building anything like the number of homes that they think they're going to build. So is the supply problem going to be sorted? No. Will people still want to buy houses? Yes. Will it be better conditions than it is today? Yes. Will inflation still be driving things forward? Yes, but at a lesser rate. So I'm comfortable with my 25% because that sees an average growth over the years of 4.7 or so. We'll hit 5 this year. I don't see too many reasons not to hit 4 to 5 over the coming few years, but going 30 plus I think might be a bit too bullish. So that probably frames my thoughts quite well, I think. Anyway, back to the UK economy. I think this is presenting, and I've thought this for some time, a workable case for the UK economy to actually do quite well. A fair bit of it is predicated, just like that capital growth I was just talking about, on getting the interest rate down. But it is folly to think that the Bank of England sets the interest rate. It only sets the short-term rate. And yes, the yield curve develops from there, but the market sets the interest rate, and the market still thinks that a 30-year UK government bond should pay a coupon of 4.626% as I say this, which I think is ridiculously high, but there you go. I dare say the market knows far more than I do. Let's look back in this video in 30 years' time and see how I got on. We also need to remember we've had a financial crash, which we'd expect to take maybe 15 to 20 years to wash through the system, especially in the way we sort of parachuted and mollycoddled our way through it, really. We only had 12, then we had a pandemic, which we would expect, looking backwards, to take 30 or 40 years to wash through the system without having an impact, and we've had 4. Still, the interest rate plays a massive part in all of this, which is the macro reason why I spend so much time on it. Still, there's a case for 2% growth to be available in the relatively near term, simply in consumption recovery. We've got that huge consumption recovery, so we're probably something like 25% off where we could be in terms of consumption, which leads to growth, which leads to jobs. So overall, that's got to be seen as a pretty good sign, I think. Government spending is likely to be quite sticky. Labour are not going to want to repeat the austerity mistakes as they're largely seen as. And I think, let me qualify that phrase, because I don't think the whole of austerity was a mistake. Government needed to cut what it was spending. There was no doubt about it. It was the way that it cut that spending and the departments that it targeted that then led to it hitting the hardest hit parts of society, who also tend to generate quite a lot of economic activity because they spend what they receive apart from anything else. So you hit a point like we did in the mid-2010s where you've got very sludgy growth because you've taken the money away that's being spent, and you've got asset price inflation, but that's just sitting there in people's balance sheets and household balance sheets because people don't want to pay the tax on capital gains. So they got richer, but they didn't crystallise those gains, and then there was no tax, or not as much tax paid on it, and it just sat there making people wealthier, which is not really helpful for the wider society, of course. So I think there is a case for 2% growth in the UK in the relatively near term in terms of its GDP, which would be really positive because all the forecasts these days say about 1.5, 1.6, 1.7, and I think we can beat it. Right now, it doesn't really matter what I think. It matters what the Office for Budgetary Responsibility thinks, because they are the people that they're the figures that Rachel Reeves has to work from. So again, if I was Rachel, I'd be lobbying the OBR, talking to them quite a lot about this particular argument that I think and I see in terms of UK consumption. That all should feed us well into the Bank of England Money and Credit Report for May, which has been released in the past few days. Now, this report's always got the mortgage figures, which is why it makes the headlines, but there's so much in there, which is why I like to take a good look. This week, a slightly longer look. So the headlines first: 1.2 billion of net mortgage debt was borrowed in May. That's a very low figure. To put it into context, the overall market outstanding amount of mortgage debt is 1.65 trillion. So 1.2 billion is less than 0.1% of that. Net mortgage approvals for purchases barely moved and stayed around 60k or just under. And that's about 5 to 10,000 mortgage approvals off what I would call a warm market. Remortgages barely moved as well, stayed around the 30,000 number. Consumer credit recovered and was £1.5 billion of growth. So more was borrowed unsecured than secured net on the month of May. And households pressed on with their ISAs for the new tax year, depositing 4.2 billion in. So consumer credit's growth rate is one thing I've been tracking, and I must say it looks a little worrying. We do need to remember pandemic base effects. So credit card usage went down massively. People tightened their belts hugely, but we're 8.3% up on the year. And credit card borrowing at 10.8% up on the year is not a sustainable growth rate, of course. And what we don't want is a consumer debt bubble. Although when the Bank of England looks at this stuff, they do tend to push it to one side, because although we're talking the billions, there's not huge money in terms of the overall financial system and, for example, 1.65 trillion of mortgage debt. I'm still watching this gap on the interest rate on new mortgages. Now, the best buys last month were about 4.3 for 5-year fixes, with those with lower LTVs and great credit, of course. The average draw in May 2024 was 4.79, which was up from 4.74 in April 24. And the average outstanding mortgage is now at 3.61%, which is up from 3.57. So as a little refresher, things are still getting worse for households, all else being equal, while the outstanding rate is lower than the new draw rate. However, these don't feel incredibly far apart at just over 1%. 1.18% on 3.61 though is 32.7% more expensive. So we do have to bear that in mind. A bit of deeper thought on this exact topic then. This might well be an obvious statement, but the majority of people who remortgaged and then refixed on a 5-year fix in May 2024, the month under discussion, last fixed their rate in May 2019. Only the majority, because some will have fixed a rate in May 22, which was still likely pretty low, below 4% but above 3 at that stage. Back in early 2019, the 5-year gilt yield was around 0.75%, 0.75. Oh, the good old days, I hear you say. But back then for the lenders, it was still the good old days. And because there was no margin on the savings, where they're currently making a nice couple of percent, all the margin was loaded on the mortgages. So even the owner occupiers were paying around a 1.5% margin and drawing at about 2.25%. The bank's figures don't go back that far, unfortunately. You can see they've only started watching this stuff, as usually happens when it looks like it might start to cause a problem. So this month in question, the average drop-off will be from about 2.25 onto an average rate of 4.79. Ouch. This differential as well continues to go up from here. Now, why is that? Because the price was still going down in terms of the draw rate until about the middle to the late of 2021. So that 2.25 is going down and down and down to an average draw of like 2, 1 and 1.75, maybe even 1.5 or lower as we got into early 2021. So that gap is continuing to go up, and we've got a couple of years of this left with that trend being the case, arguably until sort of October 2027 or so. But of course, this all depends on what happens with the 5-year gilt yield, because if that comes down, then the average new draw, instead of being 4.79, if that was to come down, say 1%, the average new draw would be 3.79. But we're still going to see a significant, it's going to be relatively consistent, even if that gilt yield does drop. So unless the 5-year gilt comes down maybe 1.5% over the next 2 years, the relative pain in those marginal households dropping off their rates is going up, not down. And that's not going to help with my consumption recovery that I'm hoping that we see. So hopefully you can see why I'm watching that quite closely. I talk quite a lot about wages, disposable income, consumption, mortgage rates, but we don't get to see data about disposable income after paying for the cost of shelter, for example. That is the real data I'd love to see collated right now by the ONS, because the cost of shelter, as discussed, has got so much more expensive whether you rent or have a mortgage to service. In fact, the true reality of the pain hierarchy at the moment looks something like this. At the top, households with a mortgage. Now remember, they've got much more average income, so as a rule, than compared to a rental household. So as a rule, they've got more to cut out of their consumption as well. Then it would be households that rent from a landlord with a mortgage. Then it would be households that rent from a landlord without a mortgage. And then it would be households without mortgage. Why? Because, of course, some landlords who are unencumbered have got a couple of things going on. One, other cost pressures, including increased compliance, increased maintenance costs, increased all the rest of it. And two, and you're not going to have seen so much of that, and they're also suffering from the same problems that the households without a mortgage will be suffering from, in that energy prices have still gone up, council taxes moving upwards and likely to move up probably quite a bit more in this incoming government, apart from anything else. Their cost pressures are still up, but they're nowhere near as much up as those whose tenure is based on mortgage debt, which, remember, is about 28% of all households who are owner occupiers with mortgage, and about 9% of households who are renters whose landlord has a mortgage, apart from anything else. So that's what's that 37% of households we're talking about there. Having said that, many without mortgage, of course, are potentially retired. I would argue the majority, and the cost of shelter has not stayed still for them, energy costs and all the rest of it. So there's a bit of perversity to some of that, and also the lack of data there is in this space leaves me speculating and talking to you in a speculative fashion rather than being able to quote numbers to the nearest decimal place, which I much prefer. But we're likely to see a poorly informed and ideologically different government now tackle the problems of the PRS, which I believe has got another 20 years at least in transition to the institutional investor space, who will take some serious convincing to ever own any stock that is older than about 20 years. When 31.3% were built before 1919 of homes in the PRS, 40.3% were built between 1919 and 1980, and only 28.2% have been built since 1980. It's quite incredible when you think about it. The danger is the mistakes the new government could make. The opportunity will be the gaping holes that some of their potentially misguided policies leave, like vast chasms in the ether. Who's going to be on top of that as quickly as possible? You, of course, alongside yours truly here, who will be pumping out the content as quickly as things can change on a weekly basis. Stay strong. Starmergeddon is not yet upon us, and Treaclegate, with a large helping of blaming the Tories and making excuses, is much more likely. Well done as always for staying with it till the end. Now save the date for the next property business workshop, which is going to be Thursday the 3rd of October. We hope you can join us. But there's only one way to deal with all this continual noise in the markets and now our election cold turkey, which we're going to go on to. Of course, keep calm, always watch the supplement and carry on.